Hi there. Thank you so much for joining us today. I'm Marche, the webinar director here at Advice Chaser. We're so glad that you're here today to be part of our educational presentation. Before we introduce our guests, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation today. Just a few notes. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today as appropriate. We do have a question and answer period at the end of the presentation. If you ask a question in the chat box and we're not able to get to it, please also leave your contact information as well. We're happy to reach out to you after today's event to make sure that question gets answered. Once again, please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to today's presenters. And here's a little bit about them. Marshall Rathmel, CFP, CPA, PFS, is a financial planner and the CEO of BCR Wealth Strategies. Marshall's time is split at BCR Wealth, allowing him to continue his enjoyment of working with the financial puzzles clients bring to the table while managing the firm and mentoring associates who will one day take care of their clients themselves. Marshall was born and raised in Birmingham, and he attended the University of Alabama. Marshall is committed to community service and leads in leadership positions in several of Alabama's nonprofit organizations. He and his family live in the Birmingham area. And our presenter, and also who is taking on moderating duties today, is Lindsey Burchfield. She is an investment analyst and vice president of BCR Wealth. Originally from Huntsville, Lindsey attended Samford University, where she received her bachelor's degree in finance. Prior to joining BCR, Lindsey lived in Charlotte, North Carolina, where she gained 2 years experience at a broker-dealer firm. Lindsey highly values relationships with others and is devoted to her client success. And I'm going to go ahead and turn the time over to you, Marshall, and we'll get this presentation going.
Thank you, Marche. So to present tax smart investing, of course, we also have to have all sorts of disclosures. So I'll let people read it and I won't bore them with it. Get straight to the meat of what we're here to talk about today. So, your financial future is made up of areas that you can control, and it's made up of areas that you can't control. An advisor like ourselves' job is to help guide people to things they can't control. When we are working with people, there's several areas they can control that we focus on. So making smart decisions about their money. This is both investments and it's planning. It's making decisions on how you spend money, how you make money, and how you grow your money. Mitigating their taxes. No matter how much you make, if you get all back to the government because you make mistakes in how you make it, then it's really not as big a number as you see on the page when you say this is what I earned. Taking care of their heirs. A lot of our clients, we specialize in typically working with healthcare providers, business leaders, and others that want to delegate. And they have a real goal to help the future generations of their families. And then making sure their assets aren't unjustly taken. There are several things you can do to protect your assets whether it be insurance, trust, others, and helping them make those decisions. Today, though, oh, and of course, there's also magnifying their charitable gifts. Today, I'm going to focus on mitigating taxes. What can you do with your investments to make sure that it's an after-tax return, not just a return that you're focused on? My goal, so I'm sure there are many of us on this call that are do-it-yourselfers, and I want to make sure you walk away with ways to handle your investments yourself to keep your taxes as low as possible. And then outsourcers who either have or are considering an advisor, ways for you to look at it and understand, what do I need to understand about what they're doing? Are they truly looking out for the tax side, or are they just trying to get as big a number on the page as possible for me? As a CPA, as a CFP, I am kind of a nerd. I do get excited about kind of looking at taxes, things like that. This does get a little technical. If you enjoy taxes like I do, it's probably not going to be something that you find too technical, but for most people, this is going to be technical. I'm going to try and break it down though and make it as absolutely simple as possible for us to follow. There's some basic things I'm going to have to start with to make sure we're all on the same page. So that basic beginning is going to be the 4-way investment accounts affect your taxes. Again, this may come as second nature to someone on the call today. For others, I want to make sure we all start in the same place and understand what we're looking at. Tax impacts of investment vehicles. So there are different laws and regulations based on how you're investing, and you need to understand how those work and how they're going to interact with the accounts that you have as well. The asset classes. So whether you're buying real estate, whether you're buying domestic equity, fixed income, emerging market equity, all those things have different tax impacts that they cause. And because of that, how you mix them with the vehicles and with the different investment accounts makes a difference. And then the impact of costs. So we've all learned pretty well that costs make a big difference. They really do. And taxes can actually be thought through with where and how you have your costs as well. Implementation. So there's an art and there's a science to this. So a lot of this is actually coming from academic research and understanding, but then you got to have the art to actually how you're going to implement it. And of course, if there are any questions, we'll be glad to answer them at the end or throughout. So type anything that you want to ask, and Lindsey will help me to find the right time to answer them. 4 ways investment accounts affect your taxes. Like I said, we all have to start on the same page. So let's start with, there's 2 different accounts if you are looking at retirement. Most accounts for retirement are bucketed into deferred accounts or Roth accounts. So the government wants all of us to be self-supportive. There's a lot of benefits to society when we're self-supportive. And so they incentivize us to be self-supportive when we stop working. So while we're working, they do certain things tax-wise to try to convince you to put money in an account that you have to hold until you're retired, and they'll give you benefits to do that. So the traditional way, typically called deferred. So let's say I'm trying to save some money today and figure out where am I going to put it and how am I going to use it to help my future. So that savings I do, let's say I put it into a traditional 401k or IRA, also referred to as deferred. When you defer that investment, you are able to deduct it from your taxes in the year that you put it in. Okay, so you do not pay taxes. I get a paycheck. I have a certain portion that I put into my 401k or my IRA at year end. I get to deduct it and again, not pay tax on that portion of that paycheck. Several years later, there was a congressman named Roth. Of course, that's how we get our names of things, right? Is they name them after themselves. So he came up with this idea of I'll incentivize you to pay your taxes on the front end, not on the back end. So they came up with this idea that you could have a Roth, you can have it in your 401k, or you can have a Roth IRA. And in this situation, there's no tax impact. You do not get the benefit when you put it in. So why would I want to do that? Let's look and see the tax consequences on the back end. Okay, for this example, I'm going to hope in real life you can earn and grow, we can earn and grow for our clients more than doubling the money. But let's say that based on time period or how someone invests. They just take their money, they double it, okay? So you have your savings, you have your growth. Once you're retired and you have that money, you take it out, and on that deferred side, the government says, I'm always going to get my taxes. You know, I might give you incentives, I might give you benefits, but someday you got to pay taxes on it. So since they didn't make you pay taxes on the upfront savings, they say you're going to pay taxes on the entire thing. And you're going to pay ordinary income taxes. That is the highest taxes that an individual can pay, is in their ordinary income tax bracket, okay? What's the benefit on the Roth side? So on the Roth side, since I put it in and paid taxes on the front end, the incentive they're giving me to do that is if I hold it until retirement, then I can withdraw the entire amount, both the savings and the growth, without paying taxes. So on one side, you are waiting to pay your taxes, and then you pay tax on the whole thing. On the other, if you'll pay taxes on the original amount, you don't pay taxes on the growth later. So let's do that in numbers, because that's going to help a lot of people kind of quantify and understand what the difference are. Okay, so let's imagine that I'm getting a paycheck for $15,000. I have $750 I plan on saving. I haven't decided what I'm going to do deferred or Roth, so let's see what happens if I put it deferred. I put $750 into the deferred side. That only leaves me with $14,250 to be taxed on, since I got to take that deduction. I'm going to imagine that this is a person who lives in Alabama. They're in a 5% state of Alabama tax bracket, and they're in a 32% federal tax bracket. Okay, so they have a tax only the $14,250, and they end with $5,272.50 that they have to pay in taxes, and their take home is $8,977.50. Of course, I'm not getting into details of Social Security and all this other stuff, but you know, simplifying it, the taxes we're talking about, you walk away with $8,977.50 as your take home. On the Roth side, let's say I decide to put the $750 there. Well, I have to do the taxes first because I didn't get the deduction. So I take my $15,000 paycheck, I have a 37% between state and federal, and I have $5,550 versus that $527,250 that I had over here that I'm paying in taxes. I then take the Roth portion out that I contribute. So my take home here is $8,700. You'll notice there's a $277.50 difference. So in the current, my excitement, my motivation, my lifestyle, what I want to do today, I want a bigger paycheck. The deferred makes a lot more sense, right? But what does that mean for my long-term and my retirement? So again, I'm imagining you only double your money, okay? In the deferred side, I'm telling people, hey, I have $1,500 saved for retirement. But what does that mean? Now, I will tell you, most of our clients, there's this myth out there, goes back many generations, that in retirement, you're going to be in lower tax brackets. I don't see that happening usually. Most people are in very similar, sometimes even higher tax brackets retirement than they were during their work years. So let's assume they're in the same tax bracket. Okay, so of that $1,500, since the entire amount is now taxed, they need that money when they're in retirement, and they have to pay $555 of it just to take it out and use it. So when they say I have $1,500 set for retirement, what they really mean is I have $945 after I pay the government so that I can have money. On the Roth side, no taxes. Again, already paid your taxes. So you have $1,500. Okay, so there's two primary ways that you get taxed in non-retirement account. Non-retirement account, the government, again, wants to incentivize us to be beneficial to society. People who buy and sell constantly and are making trades, not only is it academically unwise, and they recommend that most of the people well underperform the market, but it also is not stable for the community. There's a lot of benefits and assistance. The government wants people to put their money in, leave it in, so it's assisting the economy, assisting the marketplace. And so they incentivize you to buy something, hold it for greater than a year. When you do that, they call it long-term cap gains rate. That is a much lower rate than your income tax rate. So that's the incentive that they give you. So the cost basis is the part that you put in on the front end, and you aren't taxed on that in either situation. But if you hold an investment that grows, then that growth, when you someday sell it, gets long-term capital gains treatment. If you let me move my piece here so I can see my entire deck. Thank you. Short-term capital gains, interest on qualified dividends, they are going to tax at that highest rate. Okay, so cost basis isn't any different, but we've got an opportunity for long-term cap gains on things that we buy that are growing and things that we buy and sell constantly that throw off interest, unqualified dividends. We're going to pay a higher tax rate on. Okay, again, I'm just going to imagine you get growth. Now, again, academics would argue the person who's playing in the account, buying and selling because they're worried about what's going on in the marketplace. You know, there's a lot going on in the market today, there always is. And when there's trades going on that people are excited because they think that they can outpace the market or they can prevent downside and they cost short term, typically they underperform, but let's imagine they don't. Let's imagine that, again, 750 going up to 1500, they're both equal for this game. And on this side, you've got that lower tax rate. On this side, you got your highest federal tax brackets. So let's see what we've got. 750 in, goes by 750. That pre-tax value, again, $1,500. In this case, I'm going to assume that we've got a 15% long-term cap gains rate federally, 5% in Alabama. If you're in a different state, obviously you've got to take that into account. It's a little different. But your after-tax value, $1,350. Cost basis on the other side is still 750. The growth is 750. Pre-tax value, I'm going to tell my friends I've got $1,500, but in reality, I've got a 37% tax bracket again. And so I'm paying $270.50, not the $150. So in this case, I have $127.50 more on the long-term gain side than I have on the side where I was focused on short-term interest and unqualified dividends. So to make sure we're all on the same page before we shift over to how do you use those accounts to determine what investments to put in them, you got to think, which account do I want to have? Okay, so you've got non-retirement, you've got Roth, and you've got deferred. Well, I'll tell you, it's actually a trick question. Okay, so I gave hints to it beforehand. I'm really excited about the idea of putting a deferred account. Right, I don't have a paycheck yet. I'm thinking about what I want to get a couple weeks after my paycheck. I want my money in a deferred account. The day after the money has gone in, I do not want money in a deferred account. A deferred account is a tax liability. A deferred account causes the number that you see to actually be much less. This is going to be your highest tax account when you need the money. And so I actually don't want to have my deferred account once I put it in because there's no longer a benefit. It is actually a liability. I'm going to turn this over to Lindsey so she can talk about the vehicles that you can place into different accounts and how they affect your taxes.
All right, thank you. So now we're going to talk about the tax impact of investment vehicles, and there are several different kinds of investments that you can use to create your portfolio. ETFs and mutual funds are probably two types that you've heard of before, and they are similar in that they are both made up of, we'll call them buckets of stocks, bonds, or any publicly traded security. Let's say you have $500,000 to invest. So going out and buying thousands of different individual stocks or securities, you can invest in a combination of mutual funds and or ETFs to gain that same exposure. And just like when mutual funds were created, the majority of the funds available were passive investments, and the same with ETFs. When I say passive, I mean they track or mirror a specific index. Over the years, we have seen actively managed mutual funds become more prominent, and we are starting to see the same with ETFs. When I say actively managed, an actively managed investment, I mean the manager of the fund or investment has a specific strategy they believe will beat the market. They are not tied to a particular index. So even though ETFs and mutual funds have similarities, there are some key differences. For one, ETFs trade intraday like a stock. you can set a certain price to buy or sell the shares, whereas a mutual fund is only traded at the close of each business day. I like to think of it as ETFs you trade by shares, and mutual funds you trade by dollar amount for the most part. Also, many custodians charge fees or commissions to buy mutual funds, but do not charge fees or commissions to buy or sell ETFs. Aside from the cost from investing, there can be tax implications too. As money comes in and goes out of mutual funds, the investments within the mutual funds are bought and sold to stay within the guardrails of the fund strategy. So as investments have to be sold, that means capital gains are realized. Mutual funds are required by law to pass these gains through to the investor. On the other hand, with ETFs, because there is intraday trading and you have the activity and influence of market makers, it usually makes it so that the actual investments within the ETFs do not have to be sold, which means a capital gain may not be realized by the investor. So all things being equal, when you look at a comparable mutual fund ETF, you will typically be paying more short-term capital gains from mutual funds because that capital gain paid off in any given year, versus an ETF where you'll typically see more unrealized long-term capital gains. So even though you may have more of an unrealized long-term capital gain in an ETF, it can give you the opportunity to be strategically or think strategically about your tax liability for any given year when you are, let's say you're rebalancing your account or having to sell certain investments first, to fund a purchase or anything like that. You have a little bit more control. Now, these taxable events I've gone over, what happens when these investments are in a non-retirement account. In a retirement account, you don't have to worry about this. The options for ETFs are growing year after year, and where we're not quite yet where ETFs can construct a full portfolio of the investments we're looking for our clients, we are seeing more options. So we try to invest in ETFs where we can in non-retirement accounts, but there are still instances where we need to invest in mutual funds and non-retirement accounts. So as ETFs continue to grow, we are researching to make sure our clients are getting the most benefit from a cost perspective and a tax perspective. So it's important to think about, when your own portfolio, have you started making that transition to over ETFs and what benefit that could have for you?
Very good. Thank you, Lindsey. So real quick to recap where we've been. So we've talked about different types of accounts. Two different types of retirement accounts, and you have two different types of tax impacts in your non-retirement accounts. We've talked through ETFs and mutual funds. These are the two common, I'm going to call them buckets. So to reiterate that ETF question, these are just buckets of securities. So I can hold the entire S&P 500 in an ETF, or I can hold the entire S&P 500 in a mutual fund. But they have different laws and taxes around them and different ways that you buy and sell them. Mutual funds historically came around earlier and they're more common. ETFs are really growing fast. So again, thank you, Lindsey, that was great. How are we going to couple that with what's actually in the funds? So the different asset classes that go into the funds, for example, let's talk about Reits, real estate investment trusts. Back in the day, I was an auditor for CBL Properties. CBL Properties is one of the real estate investment trusts that is traded on the open market. It had around 120 malls that were the large indoor malls. If you were here in Alabama, you would recognize the Galleria. It's the size of what we're talking about. Think about what they have. It's a lot of income production from tenants. Similarly, if you owned a bunch of apartment complexes, There is some growth, but the majority of what they're doing is income production. So the laws around this, the taxes, are that they generate ordinary income, and they are required each year to distribute 90% or more of that income to the people that invested it. And so they have some really incredible strengths and opportunities, but they also have some weaknesses when it comes to that, because they can't really earn up to reinvest in themselves, because the money they're making has to be sent out to the shareholders. They have a lot of volatility, but they have a high expected return over the long run. So they go up fast, they go down fast, but when you talk about volatility, it's a good volatility. It's one that has a positive incline throughout it. So the last piece that's important for tax purposes is this is one of those common asset class groups that the IRS will give someone within an ETF or mutual fund an extension on getting their tax information in. When that happens, it rolls up to the fund itself, and they end up getting an extension, and then it rolls over to the custodian. The custodian is told, you don't need to give the information to the client until all the different people have had the time to do their parts. So when you own a real estate investment trust in a non-retirement account, it's not going to be an uncommon situation where you get paid 1099s, which can cause anxiety to people because they don't have this one last piece. It can also cause a reason why, if you can't get together in the time period they give it at the end, you may need to file an extension. So the preferred place is going to be a Roth IRA or a Roth OK. If you put your real estate investment trust into those vehicles, those Roth accounts in your household, then you're not being penalized in that delayed 1099 because you don't have to file on your Roth each year. And you've got that higher return of ordinary income that is being mitigated by not having to pay tax on the growth when you're retired and have to take it out. Least preferred place is that non-retirement account, because it is throwing off ordinary income. It can delay your taxes, and because of that volatility, some years you get hit with a big tax burden because it throws stuff off. Other years you don't. And so it's a lot harder to anticipate and think through how much you need to save and what you need to do to pay your taxes when you hold real estate investment trust in your non-retirement account. Okay, so let's talk about fixed income. Fixed income, also referred to as bonds. Think of fixed income as you're making a loan to governments, you're making a loan to corporations. Okay, what do they do when you make a loan to them? Just like what you have to do when you take a loan for a mortgage, right? So they're going to pay you interest. Interest is going to be taxed at ordinary income as is earned. So throughout each year, when you get paid, you have to pay ordinary income on that growth. They have a lot more volatility, and they have lower long-term growth opportunities. It is very valuable, even though it grows at a different pace than some of the other items, and it's typically going to be not as profitable. There's a reason you want to hold this. This is what defends you when the market is going down. This provides stability in your account, and for firms like us that love rebalancing, rebalancing has been shown to add performance over time. Rebalancing is done when you have that fixed income that has an inverse reaction when the market goes down. It tends to go up, and it gives you an opportunity to sell some of it and buy into the items that are on sale in the marketplace. Where do I want it? I want it in that deferred retirement account. Again, this is the account that I least like once I have it. Once I have that deferred account, it's all going to be ordinary income tax liability. The majority of your fixed income already is ordinary income. So that's not really a damage. And if it's the lower growing item within your entire portfolio, then you want it in the item that's going to be taxed the highest, your deferred accounts. Raw account, probably the least likely place I want it, because this is where you've already paid your taxes and you don't have to pay taxes on the growth as it happens. And so you're not getting the maximum benefit you can by putting a lower growing item into that account. It's worth it to have because that's stability, but I don't want it in my best tax vehicle. Domestic equity. So stocks, ownership in companies, right? So I'm looking at getting profits, and hopefully I'm making selections, and the funds are making selections that are growing over time, so that not only they have profits, but people want to pay more in future years for them. Okay, domestic equity, you can focus on long-term capital gains taxes. You can keep down that tax rate by purchasing companies that are growing companies, that are not throwing off interest, they're not throwing off dividends, that are growing, and by holding them for greater than that year. Frankly, this is the largest part of most people in the United States' portfolios. These are the names you know. These are the places that you shop and that you travel to and that you live with. And most people put their money into these specific stocks, partially also because it has a direct impact on how you feel. You know, when you see everyone around you doing well, you like to do well also. And so it's called a domestic bias, is what you find. It's not just something that happens here in America. You go over to Australia and you'll find that their Australian equity is what they tend to have more of than other things. High long-term growth opportunity. Yeah. Again, these are the companies we shop at. These are the profitable ones. These are the ones that are growing and making money. This is one of your best items to combat inflation over the long term. There's not an actual direct impact on inflation. So you can't expect that right now, if we see a large inflationary number, that means you're going to see a large growth in your domestic equity. But there is a correlation over the long term. When inflation is higher, so is your equity growth. Okay, so I'm going to prefer to put this in my non-retirement account because I've got that long-term cap gains opportunity that I don't want to put over in my deferred account. Because think about this, you ready? If I have something that I'm holding for more than a year and the government offers to bill me at a lower tax rate, but I put it into a deferred account, I just converted it into ordinary income. So I'm doing the behaviors I'm being asked to do, and I should get a lower tax rate, but when I withdraw it, I'm going to get ordinary income. So I want to put this in that non-retirement account where I can choose to sell it. I can control it. Again, big part of our job, control the things you can. Don't worry about the things you can't control. I can control where I've put this and how I'm going to pay taxes on it. You know, frankly, the least preferred place on this one's going to be situational. Do I want it in my Roth? Do I want it in my deferred account? You know, that's something you're going to have to look at your situation, your unique position to understand where it's better. But this is one that I'm going to tend towards that non-retirement account. Foreign equity. So want to buy some Nestle. Want to get into companies that are non-United States corporations that are also in non-emerging markets. So not talking about Brazil, we're not talking about China, we're not talking about Russia. We're talking about France, England, Spain, already established marketplaces. This is primarily growth. They tend to have less dividends and less interest than some of the large American conglomerate companies. They're more volatile and they have a high long-term growth opportunity. So if you were going to compare them side by side over long periods of time, not short periods of time, likely you're going to get a higher rate of return and it's going to be more in the growth area. It's important diversification to mitigate portfolio volatility. So even though it has ups and downs, if you rebalance properly, you can actually keep your volatility down by putting this in there. This is one of the key mistakes a lot of people make, is not using foreign equity. They think of themselves as being diversified, but they don't actually understand the academic term diversification. And diversification is holding all the different equities, all the different bonds of the world in proportions to create your risk and desired return. But not just saying, I'm going to buy S&P 500 US stocks and I'm going to buy a bunch of them, and that's diversification. Roth retirement account is going to be my preferred spot here. Again, if we're saying I'm going to sit and hold this till I'm well past 59 and a half, I'm going to use it later in life. This is going to be one of your faster growing pieces. And so I want to have it in my Roth where I have a lower tax impact when I am retired and I'm withdrawing it in a larger account. And again, least preferred placement. This one is also situational. It's going to be somewhere between that non-retirement account and the deferred account. Alternative investments, private equity, commodities, digital currency. I put this in because this is a question that comes up. Frankly, this is an area that most professional advisors that follow academics suggest these are typically areas that they do not recommend you getting into. I understand the question of, what do you do for high net worth customers, clients? And there are times that these pieces start entering, but a lot of this is speculative. A lot of this is not stuff that I would call investments. One of the biggest problems is when people talk about, here's how my alternative investments, my private equities, or my commodities performed. Digital currency is its own new animal as well. But when you talk about those, these aren't asset classes. I have alternative investments. Marche has alternative investments. And Lindsey has alternative investments. They can be completely different things. Same in private equity. So you can't bucket them together, and you don't understand their tax consequences unless you look at the exact deal and the situation that you're in. Because of that, they're inconsistent. There's a lot of risk to do with liquidity. The academics say that it's not recommended. Most of these items tend to have higher volatility, so you'll find periods that they outperformed, but they have lower expected return over the long term. So you want to be in it when it's doing well. You don't want to be in it when it's not. And they can cause significant tax complications, similar delayed 1099s, all sorts of other things that you cannot control once you get into them typically. And if you're looking to get in this, you've got to evaluate the individual deal and what you're in to determine what you should be doing. Because of that, can't really give you a preferred or at least preferred spot. So
we did have a question back on the foreign equity about what do you mean when you said the least preferred placement is situational?
Sure. So, the three kind of buckets I provided: Roth, non-retirement, and deferred. Okay. There are situations where every one of our clients, we manage their portfolios individually. We don't have like a specific portfolio that everyone is in. Each and every single client has their own portfolio. It's really household. Every household has their own portfolio that we're managing. There are situations where I'm going to put in foreign equity in the deferred account, and there are situations where I'm going to put it in the non-retirement, just depending on the client. When the Roth has already been tapped out, there's not Roth money. I do recognize there's also a question on, a mix of accounts. And I would definitely say for us, having a mix of deferred and Roth is a great attribute. Having one or the other, once you get to retirement, becomes very difficult with trying to pay the least amount of taxes in retirement, right? You've only got one bucket to go to, or you have too much of one bucket versus another. Roth can have a lot of advantages, and so can the non-retirement account during retirement. Some of the wealthiest people I meet seem to have incredibly large deferred accounts, but those are also some of the highest taxpayers I meet when I analyze their situation. Part 4, tax impacts of costs. So we are a fee-only financial advisor. We are a registered investment advisor. That means that we always put our clients' interest first, and we only charge them. They know exactly what will be paid. That is not the case with the majority of financial advisors out there. Most of them register themselves in a different way. But many of them are billing in ways that appear to be similar to what we do. And so when you have an advisor who charges you, whether it's entirely for their services or part of what they're being compensated for their services, they're charging you, you have to understand, how does that cost impact my return, right? So When you use a deferred account and you have an advisor work on it and there are costs within there, whether it's trading costs, commission costs, or a direct fee that they bill, the government says that you can only pay the costs of that account with other deferred accounts or itself. And let me rephrase that, because I think I said that in a way that was confusing. You cannot pay, for example, the Roth account with the deferred account. Okay, you cannot pay for the non-retirement account with the deferred account. You can only pay from the deferred account for deferred accounts. Again, remember, once I put money in a deferred account, I don't really want it anymore. I've gotten the benefit and now it's just a liability. So if I can pay someone with that account and get money out of my hands that neither I nor they pay taxes on, the government says it's okay if it's managing that account and growing that account. But it's not okay to use that account to pay for other accounts. So the Roth, very similar exact concept, right? So the government says you cannot pay for the Roth for anything but other Roths in itself. But in this situation, I don't particularly want to, right? Because the Roth is the one that I want to grow. The Roth is the one that gives me the best benefit if I can grow it. So if I can keep costs out of my Roth, I much prefer to. Non-retirement accounts, though, you're allowed to pay for it. You know, you're allowed to scratch a check and pay anybody to do any services. You've already paid your taxes. There's no incentivizing going on, and they allow you to pay for the Roth, for the deferred account, or for itself through that account. And so you're going to want to pay your Roth from your non-retirement account. You're going to want to pay the non-retirement account for yourself. You just prefer to pay the deferred accounts with themselves as much as possible. Another way to just understand, does your advisor, you know, are they doing that? Art versus science. Okay, so this is one of the best ways. If hopefully you followed most of what I've explained today, what Lindsey explained, you know, all these different pieces come together, right? I've got deferred accounts, I've got Roth accounts, I've got regular non-retirement accounts, I've got ETFs, I've got mutual funds, I've got real estate, fixed income, all these different pieces. And I'm trying to put it together to have that best after-tax return. Okay. One way to see that you're not getting that benefit is you look at it and you say, look, I've got this bucket where I've got my non-retirement account. And we've agreed that this account is going for my kids' college education, and it's going for that second house that I want to purchase. And because of that, we've got it in a, let's call it 60% equity, 40% fixed income type of approach. But then my spouse has a Roth, and the advisor said, well, because that Roth is there for the long term and it's going tax-free, I'm going to be a little more aggressive. I want that 80% stock, 20% fixed income. You know, my 403B from work. You know, imagine this is a healthcare provider at the University of Alabama, Birmingham, major hospital here. And they have a 403B account that's similar to a 401k if you work in the for-profit sector. And they say, you know, I'm going to put that in a life cycle fund. I'm going to put my Roth in a different account. My spouse's IRA is going to go into a certain account. Their 401k is going to go in a different way because of their age. Maybe they have a different age, so they have a different life cycle fund. If this is the way you're doing it, this is the way your advisor is doing it, looking at account by account, this is not very tax smart. It's not very tax efficient. Each account is not using the specific items that it can best benefit from using for the household. It's just being invested based on like a singular goal, not on the goal of the household. Tax smart accounts are going to incorporate all the accounts into the risk that you need to take. So you're going to look at all those things, and maybe instead of having some 80-20 accounts, some 60-40 accounts, I say, you know, to reach all of our goals, we need to have an overall risk and approximate return that we would expect from 70% equities and 30% fixed income. And so I'm going to take that Roth and I'm going to start by putting my real estate in there. because as I discussed, that's kind of the real benefit there. I got that 403B, great place to put that fixed income. And I'm going to start filling it out until I get to the 70-30, but it's not each account invested on its own, and it's not each account invested towards a specific nature. It's each account being used as a part of the total, what the household has, to reach all the goals together in the most tax efficient way. Okay, so putting all that together, you know, where do I find that perfect account? How do I put a household together where my IRA is holding the fixed income and my Roth is holding that? This is where that art versus science comes in. I do want to warn you, even if you look at our clients' accounts or if you look at your own, you can have the most tax efficient. It will not be perfect, okay? Because you're going to have a certain amount of Roth, and it might be more or less than you need for real estate. You're going to have a certain amount of your deferred accounts. Many times, like I said, people come to see us, they've kind of built up their retirement. They haven't built up other pieces. They've got to put some of those things they want outside of the deferred account into it because that's the bulk of what they have. And so we don't see that as always, you know, it's going to be perfect. That's where we're going. But at the same time, don't let the tail wag the dog. Okay. Don't look at it and say, I need to save the taxes. I want to make sure that this is tax efficient. And so I'm going to take on too much risk or not enough risk. Okay. Really important to consider tax, but you gotta put diversification, rebalancing of risk ahead of the tax benefits. That is the conclusion of what we've prepared, Marche. Lindsey and I appear to have some more questions if you'd like to let us know what else we need to ask.
Absolutely. I've gathered the questions here, Lindsey. I'm going to send them to you here, but I have one to get us started. What is your position on Roth conversions in retirement?
Oh gosh. So I'll be honest with you, right now, I love a good Roth conversion. Roth conversions have an incredible impact on your beneficiaries. They can have an incredible benefit on your position later in life, and they can have a great impact in the current, reducing required minimum distributions in the near term years. But frankly, that is very based. I mean, we have to do significant analysis on a client to understand how it affects them and their situation. So I'm a big proponent, but we use some pretty heavy software to try and analyze the situation and understand when is someone going to need it, how are they going to use it, and will it, you know, have a high likelihood of lowering taxes. One of the reasons I like it so much, current tax law that we're sitting under that was changed not just a few years ago is set to sunset in 2026. So particularly for my higher income earning clients, whether that be during their working years or because they've amassed significant deferred accounts and pensions that are taxing them heavily right now, we anticipate that whether it's 2026 or another time, we are going to have the current tax rate sunset and we're going to have higher tax rates. So it almost gives us an extra incentive to say we want to do the Roth conversion now while we can, knowing that we expect, unless other tax laws get put in, which obviously they always do, but you know, there's already a set for the tax rates to go back up.
Marshall, would you suggest that the best way to maximize your retirement is a combo of both deferred and Roth accounts? I have a 403B and it is pre-tax income and no Roth IRA.
Sure. So first of all, nowadays, most retirement accounts allow you, employer-sponsored retirement accounts, I should, allow you to put money in through Roth. Their matches are not. Their matches are deferred. And so one way to get a combination is to put your money in via Roth and get the match from deferred. I do recommend having a mix, but you also want to have a mix of non-retirement. You know, you get to retirement 5 years in and we're looking at a big, you know, withdrawal because you want to do something for grandkids, or you have a big trip you're going to take or something you're going to do, and it's going to spike your taxes this year if you aren't able to adjust it and make good decisions. If you've really only been putting money into that deferred account, you got no choice. You're going to put yourself in a new tax bracket versus opportunities with that non-retirement and that Roth.
Okay. Next question. What are strategies we use for high net worth customer clients?
Sure. So, that is a very open-ended question with so many answers I could give. We have a tremendous number of things we look at from the tax side, from the financial planning side, and the investment side. The stuff we're talking about today, the tax side, it really doesn't matter. We are looking at the tax consequences, whether someone's high net worth or they aren't high net worth. No one wants to pay more taxes than they have to and to reduce their earnings. But I probably need to follow up and understand that person's specific desires and needs to talk through some of the planning we do for our higher net worth clients and some of the other planning that we do beyond just taxes.
Okay. Let's see. Can you summarize again what is best to put in a Roth IRA?
Sure. So I would say I start with real estate. If there is a real estate piece, some ETFs and some mutual funds will include real estate within their domestic or their international funds. We tend to use ones for risk reasons that carve it out, and then we use a specific investment just for the real estate piece. When you do something like that, it allows you to not only play with the risk part and make sure you're taking on the right amount of risk and expected return for yourself, but you also can put that in that Roth. Other things I would put in there are probably your emerging market equity, your fixed income, and sometimes when we have a client who does have some sort of private equity, a higher net worth client that has a reason to have some sort of private equity in there, based on its tax impacts, a Roth can be very beneficial.
To follow up with that question, someone said I have a Roth through my employer with the match, but the match is not going to be Roth from my understanding. How is this addressed from a taxation perspective?
I'm sorry, ask that one more time. I didn't quite follow that.
So they have a Roth, I guess 401k through their employer, and there is a match, but the match is not going to be
right. Okay.
Roth. Yep.
Yeah, I got it. So your employer and I've never found it to be different. I'm not saying it couldn't be different, but I've never found anyone who wants to pay the extra taxes because you're putting in Roth and they're going to put in Roth. An employer match is kind of defaulted to being the deferred account that it is contributing to. So you're going to have a deferred and a Roth portion of your retirement account at your employer. When you go to withdraw it, whether it is in retirement or you're changing jobs and you want to roll it into outside accounts or to your next employer, then they're typically going to either scratch two specific checks, one for the Roth portion and one for the deferred portion, or they may scratch one check that has an explanation on it of this portion is for Roth only, this portion is deferred only.
Let's see. Can you explain the difference between a Roth IRA and a Roth 401k?
Yeah, so that is a great one. As a matter of fact, I've taught a good bit over the years at the Master of Accounting program in Tuscaloosa, where I went to prepare to get my CPA license. They asked me to come speak to the graduating students, and that is one that even students graduating that program, sometimes it can get a little tricky. They have the exact same tax impact. The difference is one's coming out of your paycheck and has a different limit than the other. And this is where, like I said, even Master of Accounting students sometimes call me and get confused, is you'll hear numbers thrown out there. For 2022, the Roth contribution in a 401k is the same as a deferred contribution. You can pick or choose one or the other. You can go up to $20,500. In a Roth IRA or a traditional IRA, you can do up to $6,000. Now, I'm not getting to if you're over 50 and all this kind of, there are other complicated rules, but for most people who are watching this, likely you can do both. If you qualify to do it into a traditional IRA or a Roth, you that portion, and it does not impact the numbers in your 401k, your 403b, your employer-sponsored retirement account. They have different limits is really the best thing to explain as to what the differences are. They have more commonality than they have differences.
Okay, maybe one more question on the, or another question on the Roth. If you've maximized your Roth, maybe, I guess if you've maximized your Roth IRA, what should you try to maximize next?
So if you've maximized your Roth IRA, it's unlikely that you have other retirement accounts. There are some strange situations for some of our doctors at hospitals or pharmacists that we represent, where they may have 457s or other complex vehicles that are provided to them. For the most part, you're going to be putting money into a non-retirement account. This is one of those I think worth taking a second, and I don't want to say harp on, but I do like to push the point a little bit more. I've had high net worth individuals tell me in a very confused way that the limits that the government gives them, like that 20,500 I gave, is government saying how much they need for retirement. That is not the case. The government is determining how much they're willing to incentivize you to save. They are not looking at your individual situation and determining what is beneficial to you. Many of our clients need to save far larger numbers than the limits on retirement accounts towards retirement. And that point, you need to start putting it in non-retirement accounts.
Can you talk a little about fees for financial advisors? Managed accounts, there is generally a fee. So someone says they pay 2% annually. Are you paying for the manager's expertise?
So I think I followed that question. You went a little in and on me there, Lindsey, but when you are paying an advisor, there's a couple of reasons. Most of our clients are paying to delegate. So again, we tend to represent individuals that in their lives, they've been successful because they do what they do best, and they find someone else to assist them at a more cost-effective way than their time and things that they don't enjoy doing, so they can spend time with their families. So we are experts in financial planning. We're experts in investment management. And so people hire and pay us so that they can do other things. Okay. We don't promise to outguess the market and do some sort of wild things. We get our clients what they deserve for putting their money at risk in the market. We tell our clients, we're going to try and fund capitalism ventures that are all out there in the world. And you should want to get what you deserve. We're proud of our return, but we don't try to beat everybody else, because that's the best way to lose, is to make mistakes. The people who are being paid to make the actual underlying investment decisions are typically going to be your ETF and your mutual fund managers. The advisor that you're hiring is selecting which ones of those are the right ones for you. They should not be doing that to try and outperform the market or outguess, because that's a good way to lose. A lot of what we do is financial planning, frankly. There's a lot of value. There's several different studies out there that show a significant increase in long-term lifestyle and long-term net worth for using an advisor who does financial planning, tax strategies like we're talking about today. And it's really in my mind, those that choose to pay us are doing is they are using our expertise to get their planning right and delegating that investment piece.
Well, we have gone over time just a little bit. I know that our participants have had lots of questions, and we are not able to get to them all. I do have a final couple of questions I can ask, and then we'll wrap things up. One question we had, you talked about that Roth conversion analysis software doing a Roth conversion analysis in retirement. Is that software available to the general public?
The software we use is not. No, that's something that we license and is not available for one-off use by the general public.
All right, and then one other question here. If you're over 50 with a simple IRA through your employer and you have a Roth on your own, should you maximize both? Contributions?
Unfortunately, there's so many other things that go into that question, Marche. I wish I could give an easy answer. I'd really need to look at what else you have, because like I said, once you get into retirement, yes, being over 50, having a simple IRA and having an employer, or it looks like it's a simple through an employer, and then having accounts on your own, there's a benefit to non-retirement as well. And so you'd have to weigh what you currently have.
Well, that brings us to the end of the time we have today. I want to thank both Marshall and Lindsey for being here. We're getting some thank yous from our audience. I do want to say, as I'm finishing up today, if we have not had a chance to get to your question, go ahead and leave it in the chat. I will save the chat and I will make sure that our team has a chance to reach out to you to make sure that that question gets addressed. Once again, thank you so much for the organizations that have made this webinar possible today. I'm going to pop back up Lindsey and Marshall's bio.
Thank you, Marche. We
again.
really appreciate you having us.
Yeah, we appreciate you. We'd love to have you back. Just a second here. I'm going to get back into my slideshow. My apologies here. A little more about what Advice Chaser offers. We're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. All you have to do is go to advicechaser.com and click on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Bye, everyone.